There are certain types of properties in San Francisco that look good on paper, but actually turn into financial nightmares. And in this video, I'm going to show you exactly what to look out for. Hi, my name is Epstein, and I'm a lifelong San Franciscan and realtor here in the city. On this channel, I give you the real, unfiltered truth about real estate in the city. The stuff that most agents don't tell you. In today's video, we're going to talk about the 10 types of properties you should look out for before buying in San Francisco. By the way, if you're thinking about buying, selling, or renting in San Francisco, I'd be more than happy to be a resource for you. I will tell you the truth about a property, so please feel free to reach out to me at the contact information below. And if you want more honest local insight into San Francisco real estate, please make sure to subscribe. Number 1, deferred maintenance nightmares. The biggest mistake I see first-time homebuyers buy in San Francisco is underestimating the amount of money it takes for deferred maintenance on a property. A property that looks good on paper can turn into a financial nightmare if you don't know what to look out for. Here's what can happen. You're looking at a Victorian in the outer Sunset. It's listed at $1.1 million, which is $200,000 less than comparable homes in the neighborhood. You think you're getting a steal. You make an offer, get into contract, and that's when the issues arise. The foundation is sinking, and the experts are telling you you need underpinning. This can easily cost $60,000 to $100,000 in San Francisco. Next, the electrical panel is outdated. You realize that you need to bring it up to modern code. This costs an additional $20,000 to $40,000 for a full rewire. Because the roof is original and from the 1920s, you realize you need a brand new roof. This replacement costs another $25,000 to $40,000. Lastly, due to the building's age, the plumbing is galvanized steel. Due to its corroding, you realize that it's going to need to be replaced in the next couple of years. That's going to cost another $20,000 to $30,000. Suddenly, your $200,000 discount has disappeared, and you actually need to spend $150,000 to $200,000 immediately for the house to be livable. And here's the thing, because we live in beautiful San Francisco, prices here are very high. Materials are high, labor is high, everything costs a lot of money. On top of that, permits take time and inspectors can be strict. So you might be asking yourself, how do you avoid this? First, you should look beyond the list price. If the property is significantly cheaper than comparable homes, there's usually a reason. Secondly, if you're looking at a fixer-upper, try to get contractor estimates before you put in an offer, if possible. The cheapest house on a block is usually cheap for a reason. And in San Francisco, fixing those reasons can cost a fortune. If you're not prepared to take on a major renovation, then you should probably avoid homes with a lot of deferred maintenance, even if it's priced below market. In the long run, you'll end up spending a lot more. 2, condos with low HOA reserves. A condo with low HOA dues might seem like a great deal. That very well may be. However, if your building doesn't have adequate financial reserves, then you might be setting yourself up for a major financial burden. Here's how that works. Every condo has an HOA, and that HOA collects dues from every owner. Part of those ongoing dues goes towards things like utilities, maintenance, and landscaping. The rest of it goes into reserve funds, which you could think of as a huge, big savings account. The purpose of the savings account is to pay for big repairs and capital improvements. For example, when a building needs to replace a roof, repair its elevators, or maybe do some seismic retrofitting, that money comes from the reserve account. If the reserves are healthy, the work gets done and the owners don't feel much of a financial burden. On the other hand, if reserves are low or depleted, an HOA can call for a special assessment. This is a one-time charge to each owner to cover the cost of the work. In San Francisco, these special assessments can be massive. I'm talking $50,000, $75,000, or even $100,000 worth of work. It all depends on the scope of work and the amount of units. I've heard tons of stories from other agents in my office and in news articles about buyers who have bought condos long ago in nicer neighborhoods like Nob Hill or Russian Hill. These are beautiful units in nice locations, and HOA dues were $300 to $400 a month, which might sound like a steal. Then, a year after closing, something dramatic happens. The building's 100-year-old facade starts crumbling, the elevator fails inspection, or major seismic work needs to be done. When this happens, the HOA must issue a special assessment. For a 30-unit building facing a $2 million repair, that's about $67,000 per unit. Owners typically have 60 to 90 days to pay for this expense. Otherwise, they risk getting a lien on their property. Typically, this happens because previous HOA boards don't fund the reserves enough. Also, buyers didn't catch it because they didn't know what to look out for. So here's what this means to you and what you should do. When you're buying a condo, request the HOA financial statements. Specifically, take a deep look at the reserve study. This is a report that estimates the building's large expenses over the next 20 to 30 years. Here's where you'll be able to determine whether or not the reserve is funded adequately. If reserves are below 50% funded, that's a red flag. If there's no reserve study whatsoever, that's an even larger red flag. Another thing you can do is look at the meeting minutes from the HOA board meetings. Take a look at it and see, are they talking about any upcoming repairs? Any special assessments, any ongoing lawsuits or major deferred items? All of this information should be available to you as part of your due diligence. A building with a $200 HOA due and no reserves is actually a lot riskier than a building with $400 HOA dues and fully funded reserves. Don't just look at financial costs, but rather the financial health of the building. In the long run, this can save you tens of thousands of dollars. Number 3, the true cost of ownership. One of the biggest mistakes buyers make is focusing only on the purchase price and not only on the monthly ongoing fees. Here's the reality. High HOA dues and property taxes can make a property nearly impossible to sell. This could be the case even if you got a good deal on the purchase price. Here's why. When a buyer applies for a mortgage, the lender is looking at their debt to income ratio. That's the percentage of their monthly income that goes towards debts. Lenders typically want to see a DTI below 43%. When they calculate that ratio, they're looking at the mortgage payment, taxes, insurance, HOA dues, amongst other things. Let's say you're looking at a condo that costs $1.2 million. Your mortgage payment is going to be around $6,000 a month on it. However, your property taxes in San Francisco are going to add another $1,200 to this a month. On top of that, the HOA dues are going to add another $1,800 to that a month. That's a total monthly carrying cost of about $9,000 a month. To qualify for that, you'll need a household income of about $250,000 a year. That's doable for some households here in San Francisco, but it eliminates a huge buyer pool. Now, let's say theoretically that you want to sell that condo 5 years later. Luckily, the carrying costs haven't changed much for you. However, the buyer pool is still limited to households making $250,000 a year or more. But in the meantime, interest rates have gone up. Due to that, the mortgage payment is now $7,000 versus $6,000. That pushes the total monthly cost to $10,000 a month and pushes the income requirement even higher. Suddenly, because of that, you're sitting on a house that many people can't afford and sits longer on the market. When you do get an offer, it might be under ask because buyers understand that this is a tough property to sell. This is especially true in buildings with very high HOA costs. I'm talking $1,500, $1,800, or maybe even $2,000 a month or higher. These are typically luxury buildings with a ton of amenities. Think doorman, gym, pool, or maybe even concierge service. These amenities are great, but they come at a cost. And that cost is making the property harder to sell. Before you buy a property with high monthly carrying costs, think about who's going to actually buy that property when it comes time for you to sell. If the answer is not that many people, then you might want to reconsider. By the way, if you've ever been burned by one of these property types or have dodged a bullet yourself, drop a comment down below and let me know. Number 4, properties with unpermitted work. Unpermitted work is one of the most common issues I see regarding San Francisco real estate. And unfortunately, I see it as being one of the biggest deal killers when it comes time to sell. Here's what I mean by unpermitted work. Anytime you do construction that adds square footage, changes the use of a room, or involves structural, electrical, or plumbing changes, you're supposed to get a permit from the city. That permit ensures that the work is built to code and is done safely. Once the work is complete, you get a final inspection and sign off from the city. However, in San Francisco, it's quite common for a lot of homeowners to skip over this process entirely. There are 2 main reasons why this is the case. First, permits cost money. Between permit fees, plans, and hiring licensed contractors who pull permits, that can easily cost 20 to 30% of the total cost of the project. Second, permits take time. Dealing with the city can cause months of delay. Some homeowners don't want to deal with it, so they just continue to do work without permits. Now, it's important to note that not all unpermitted work should be treated equally. There are different degrees of severity. Now, on the minor end, you might have things like replacing a water heater or swapping out a few windows. Technically, those may require permits, but not a lot of people get them. Many lenders and buyers will never make a big deal of that. But on the other end of the spectrum, you have major unpermitted work. This can be adding a bedroom, adding a bathroom, converting a garage to living space, or expanding the building's footprint overall. That's a completely different situation, and that's where you run into serious issues. Here's one reason why. When you sell your house, the buyer's lender is going to order an appraisal. When the appraiser looks at the public record to see what your house is, it might be listed as a 2-bed, 1-bath at 1,500 square feet. But when they walk into the property, they notice 3 beds, 2 baths, and 1,800 square feet. This discrepancy in terms of extra square footage and bed and bath count is all unpermitted work. Due to that fact, the appraiser can't count that space towards the appraisal. So even though the home physically has 3 bedrooms, the appraisal is based on 2 bedrooms. What this means in practice is that the buyer can't get a loan for the full value of the property. The lender will only finance based on the permitted square footage. This can kill deals. I've heard of many buyers getting out of contract because they couldn't get financing in order. I've also heard of sellers that have had to drop the price 6 figures to try to lure cash buyers so they don't have to deal with financing issues. This is a huge problem. Now, sometimes this unpermitted work can actually work in your favor as a buyer. If you're buying a property with unpermitted space, you might not be paying full price for that property. Due to that, you might be getting an extra bedroom or bathroom without having to pay full list price for it. This can be a good deal, especially if you're okay with the risk and you're staying long term. However, when the time comes for you to sell, this can come to haunt you later down the line. And you might be thinking, can't I just get this work permitted after the fact? Sometimes the answer is yes, but it's expensive and complicated. You will likely have to hire an architect or an engineer to draft up plans and show that your work was done according to code. Then you have to submit those plans and submit it to the city, which can cost thousands of dollars. Lastly, you have to hope that the city approves it, and if not, you may have to make major changes. In many cases, the work can't be permitted at all. Maybe the ceiling heights in the basement bedroom are too low. Maybe the addition violates setback requirements. Maybe the plumbing was installed in a way that doesn't meet code. If any of these become the case, you really have 2 options. You rip out the unpermitted work and restore the property to what it was originally, or you can sell it as is and accept the fact that the buyer pool is going to be limited. So how do we avoid this? Before you buy a property, pull the permits and compare them to the actual layout of the house. If the square footage doesn't match or there's rooms that aren't on the permit history, ask the seller for documentation. If they don't have it, you can assume that the work is unpermitted. And if that's the case, factor it into your offer or you can walk away. Don't assume you can just fix it later. It's expensive, time-consuming, and not always possible. If you're serious about buying a property with major unpermitted work, it might make sense to talk to a contractor and get an idea of what it would cost to fix that issue. Number 5, TIC versus condo confusion. TICs are one of the most misunderstood property types in all of San Francisco. A lot of buyers see that a TIC is listed for $100,000 lower than a condo and think that they're getting a great deal. That could be the case, but they don't understand the legal and financial differences between a TIC and condo. Those differences can cost you big time when it comes time to sell. A TIC stands for tenancy in common. In this, you don't own your specific unit. Instead, you own a percentage of the entire building. So to think about this cleanly, if there are 3 units in a building and it's a TIC, you own about 1/3 of the building, or 33.3%. In this agreement with other owners, you have the exclusive right to your specific unit on that property. A condo is much different. In a condo, you own your unit outright. This means that it's deeded to you individually. That means that you can sell it, refinance it, or potentially rent it out without permission from other owners in the building. With a TIC, everything is more complicated. If you want to refinance your loan, you can't just do it on your own. All the co-owners are on the same loan, so if you want to refinance, everyone has to agree to it. If one person has bad credit or doesn't want to refinance, you might be stuck. If you want to sell your share of the TIC, the buyer has to be approved by the other co-owners. And even if they do get approved, the buyer has to find a lender that is able to lend on TICs, which is less frequent and less common. Not all lenders do TIC loans. The ones that typically do require at least 20 to 25% down and have higher interest rates compared to single-family homes and condos. This makes TICs much harder to sell. Your buyer pool is smaller because fewer people can get financing. And even if they do find financing, they're often turned off. They're turned off by the complexity and legal risk of being tied to other owners. Word on the street is that TICs often sit on the market a lot longer than the comparable condos. And when they do sell, it's typically for significantly less, even if it's in the same or similar building within the same area or neighborhood. With that being said, TICs aren't always a bad idea. If you're planning on staying long-term, are comfortable with the financing restrictions, and understanding the risks, then a TIC can be a great entry point. It's a great way to get into a neighborhood that you otherwise might not have been able to afford. There's also a possibility of converting that TIC to a condo. San Francisco has a lottery system for converting TICs into condos. Every year, the city allows for a limited amount of buildings to convert. Don't expect this to happen because the wait can be 10 to 20 or even more years. Even if you win the lottery, the conversion process is expensive. Often this is $50,000 to $100,000 per unit in legal fees, permit costs, and other miscellaneous fees. So here's what I'll say. If you're thinking about buying a TIC, make sure you know what you're getting into. Talk to a lender before you make an offer and confirm that you'll be able to get financing. Ask about the terms of the TIC agreement. How many co-owners are there? What happens if someone wants to sell or refinance? What are the rules around renting out your unit? And most importantly, think about resale. When you're going to sell, you have to accept the fact that you're going to have a much lower buyer pool than if it were a comparable condo. That means that a potentially lower amount of offers and longer days on market. Don't just buy a TIC because it's cheaper, understand why it's cheaper. Number 6, structural red flags in older buildings. San Francisco's older buildings have incredible charm. Victorians, Edwardians, these are beautiful San Francisco staples. Unfortunately, a lot of these were built in the late 1800s and early 1900s. And with that, many of them have serious structural risks that buyers need to understand. The most common issue is foundation problems. Most older homes sit on post and pier foundations or older unreinforced brick foundations. Over time, these foundations can settle, crack, or even start to sink. If the foundation isn't properly bolted to the structure above it, the house can shift or even slide off during an earthquake. Foundation work in San Francisco is extremely expensive. A basic foundation repair can include things like leveling the home, replacing rotten posts, or reinforcing the foundation. This can easily cost $30,000 to $60,000. A full foundation replacement can easily cost $80,000 to $150,000. This obviously depends on the size of the home and complexity of the scope. I've heard stories about buyers who found minor foundation cracks and thought that it wouldn't become an issue. 2 years later, cracks started spreading. Doors weren't able to close properly. Floors started sloping. And when they brought in an engineer, they said that the foundation was failing and that it would cost $150,000 to $200,000 to repair. This is a huge financial strain that could have been avoided with proper due diligence. Another issue worth mentioning is soft story buildings. This is a building with a garage or other open space on the ground level that has living spaces above it. These buildings are vulnerable to collapse in an earthquake. This is due to the ground floor not having enough structural support. San Francisco passed a mandatory soft story retrofit ordinance a few years ago. If a building falls under this, then you're required to do a seismic retrofitting. This can easily cost $80,000 to $150,000 of work for a single family home and much more for a multi-unit building. If you're considering purchasing a building that might be subject to this requirement, I recommend that you check the city's website for more information on this. There is also a map of affected properties, which is super useful. Other structural red flags to look out for include cracked exterior walls, sloping floors, windows that don't close properly, water intrusion, and rot. These are all potential signs of structural issues. If you're buying an older home in San Francisco, you might want to consider hiring a structural engineer to take a look at it. This can easily cost $500 to $1,000 for a walkthrough, but it will give you peace of mind and let you know an idea of what you're dealing with. I don't recommend falling in love with a home and ignoring structural red flags. Victorian homes are undoubtedly beautiful. However, if they're sitting on falling foundations, that charm comes at an extremely high price point. Number 7, homes on busy streets or with serious noise or location issues. One of the most overlooked factors are homes with noise or location issues. You can have the most beautiful home, but if it sits on a beautiful street or right next to the freeway, it might become a huge issue when it comes time to sell. Here's the reality. Most people are willing to pay a premium to avoid these. The reality is that homes on busier streets can sell for significantly less than comparable homes on quieter blocks. And I'm talking easily 10 to 20% less, sometimes even more. You might be wondering what constitutes a busy street in San Francisco. Some of these include major thoroughfares like Gary Boulevard, 19th Avenue, or Van Ness. These are streets with constant traffic, multiple lanes, buses running all day and night, and very little peace. If you're looking at a home on one of these streets, you need to know what you're signing up for. The noise could be constant. Cars, buses, motorcycles, horns, sirens, you might hear all of it. Beyond the noise, there are other obvious issues. Street parking can be extremely difficult in these areas. There are also safety concerns, especially if you have kids or pets. Overall, busier streets tend to be less pleasant to live on. Areas like Potrero Hill and Bernal Heights have areas that are within very close proximity to freeways. These areas can be major turnoffs to buyers. Cable cars and muni lines are another consideration. If you're on a street that has one of these, that can be constant noise. Now here's the thing, you might be someone that doesn't mind noise. Maybe you're used to living in a city and the noise doesn't bother you. Maybe you work long hours and you're never at home during the day anyway. If that's the case, buying a home in these areas might be a smart financial move. You're buying these homes practically for a discount. But here's what you have to understand. When you go to sell your home, many others won't feel the same way. Due to that, you're gonna have a much smaller buyer pool when it comes time to sell. That might mean that you sell the property for less and it sits on the market longer. Ultimately, location is the one thing that you cannot fix during a renovation. You can replace the kitchen or fix the bathrooms, but you can't replace where your house is. Before you make an offer on a property with noise or location issues, think about what it's gonna be like to resell the property. Number 8, parking nightmares. Parking is one of those things that buyers often overlook. In San Francisco, parking can make or break a property's value. Here's the reality. Even though San Francisco has pretty good public transportation, bike options, and rideshare, many people want at least one dedicated parking space. Properties without parking spaces tend to be much harder to sell than properties that have one. Why this is the case is obvious. Street parking in San Francisco can be daunting, especially in certain areas. Even in residential areas where you can get a parking permit, that doesn't guarantee a spot. In areas like Russian Hill, North Beach, or the Marina, you can easily spend 20 to 30 minutes trying to find a parking spot. And if you live in an area with hills, that makes it even worse. People don't want to park floor blocks away and have to go up or down steep hills. Even if someone doesn't own a car, they like the ability to have one in the future or have their guest park. Also, parking can add significant value to the property. In San Francisco, a garage or parking space can easily add $100,000 to $200,000 or more to the value of a property. That's how valuable parking truly is. On the flip side, properties without parking can take longer to sell and sell for much less. Obviously, there are some neighborhoods where parking matters less. These tend to be in areas like Mission or Soma that has great public transit access. Even in those areas, properties with parking are a major selling point. Parking is one of those things that can seem minor until you don't have it. Don't underestimate how much this can matter in San Francisco. Number 9, HOA or condo restrictions that kill flexibility. One thing that buyers tend to not think about until it's too late are HOA restrictions. Some HOAs have serious restrictions on what you can do. When it comes time to sell, those restrictions can be a major turnoff. Let's break down some of the most common types of these and why they matter. First is rental restrictions. This is a huge one. A lot of HOAs in San Francisco have restrictions about renting your unit. Some don't allow rentals at all. You actually have to be an owner-occupant. Other buildings cap the percentage of units that are able to do this. Many times the building is at the cap, and that means that you can't even rent out your unit if you wanted to. Another restriction are allowing short-term rentals like Airbnb. These are very commonly prohibited. Most HOAs have explicit rules banning these in San Francisco. They matter because buyers like flexibility. Even if you're buying a condo as a primary residence right now, wouldn't it be nice to be able to have the option to rent it out in the future? If this is important enough to a buyer and you have that restriction, you just eliminated them from the buyer pool. Another common one are pet restrictions. Some HOAs have strict rules regarding pets. They might limit the size of the dog, the amount of pets you have, or even have breed restrictions altogether. If you're a dog owner and you're looking at a building that doesn't allow dogs over 25 pounds, that could be a deal breaker. Next are renovation restrictions. Restrictions. A lot of HOAs require you to get approval before doing any kind of renovation. This can even be the case for cosmetic things like painting or installing new flooring. This approval process can take a long time. You have to submit plans, get board approval, and sometimes even get approval from neighboring units. It's a hassle, and a lot of times buyers just don't want to deal with that. Lastly, there are co-ops. Co-ops are not that common in San Francisco, but they do exist. In a co-op, you actually don't own your unit. Instead, you own shares in a corporation that owns the building. Those shares are what gives you the right to occupy a specific unit. Co-op boards have a ton of power. They can reject buyers for any reason. They can interview buyers, review their financials, and decide whether or not they're a good fit for the building. This makes them extremely difficult to sell. A lot of buyers won't even look at co-ops because they don't want to deal with that level of uncertainty. Before you buy into an HOA or co-op, read into the CC&Rs. That's the Covenants, Conditions, and Restrictions document. This lays out all the rules. Pay attention to the rental restrictions, pet policies, and renovation approval process. If the rules are overly restrictive, think about the resale value and think about what you're willing to accept. Ultimately, flexibility matters and buyers want options. By limiting options, you're making units harder to sell. Number 10, unique layouts that hurt resale value. Layouts are very important when it comes to the desirability and pricing of a home. You might fall in love with a quirky Victorian and a unique layout, but when it comes time to sell, it might come to haunt you. The truth of the matter is that most buyers want a simple, traditional, functional layout. They want bedrooms that feel like bedrooms with closets and privacy. They want a bathroom that makes sense. They want a logical flow from room to room. If you have an unusual or choppy layout, that can be a turnoff to many buyers. Let me give you some examples. Victorians and Edwardians are notorious for this. You might have a living room that's only 10 feet wide, or you might have a hallway that's so narrow that even one person can barely fit through. Many have bedrooms that are connected to one another with no hallway in between. This is called a railroad layout and is often a problem. If you're single or have one other person that you know well, it might be okay with you, but for others, it's a huge deal breaker. It's a privacy nightmare. Another issue is bedrooms without closets. In San Francisco, if a bedroom doesn't have a closet, it's not legally a bedroom. So if you see a 3-bedroom home, but one of the bedrooms doesn't have a closet, it's legally a 2-bedroom home. When you go to sell, that's going to affect your appraisal and resale value. Bathrooms off the kitchen are another major turnoff. I've seen older homes where the bathroom is only accessible by going through the kitchen. Buyers hate this because it's awkward, unsanitary, and can make the home feel poorly designed. Lofty bedrooms are trendy in some markets and are undesirable in others. In San Francisco, they often don't sell well. They can look great in photos, but tend not to be functional for buyers. You're dealing with privacy and sound issues, and they're not very safe for kids. Storage is another major issue. San Francisco homes are notorious for a lack of storage. If a property has no closets, no pantry, no laundry room, and no garage, buyers are going to struggle to see how they can fit their things. Even if you find creative storage solutions, many buyers won't want to deal with that. I would urge you to think about resale value from day one. When you're looking at a property, think 5 to 10 years down the line, if you were going to sell that property, would it seem like an issue to other people? If the answer is yes, you may want to reconsider. None of this is to say that you should never buy one of these properties. Sometimes the right property for you is one of these options. You just need to make sure you're going in eyes wide open. I just want to inform you on things to look out for because many times buyers are blindsided by things because they don't know what to look out for. If you're looking at buying, selling, or even renting a property here in San Francisco and you want an agent that is going to tell you the truth, please feel free to reach out to me. I'd be more than happy to be a resource for you. My contact information can be found below. And if you found this video helpful, make sure you subscribe for more content. Like this video if it helped and comment down below if you ever encountered one of these property types. Thanks for watching and I'll see you in the next one. Bye.